It's Brian Preston, the Money Guy.
So far, Bo, I like that we have discussed traditional just backdoor Roth contributions. We've done mega backdoor Roth, and those are all tax-free. There is another component of tax-free growth that we love to discuss on the show, and this is financial order of operations, step number 5 of tax-free growth. We love health savings accounts.
Yep.
HSAs are tremendous, and you guys know I love the fact that these things are triple tax advantage. I mean, it just gets me so excited to talk about it.
I'm going to go even a step further. Sometimes they're even quadruple tax advantage. We've always said triple tax, and our audience, you guys, you financial mutants, always call us on that. Yes, sometimes it's even quadruple tax advantage.
So let's talk about this, because we have siblings here. We have the HSAs that grow tax free, and we'll explain what I mean by that in a second with the triple tax advantage. But then you have Roth IRAs, and you're like, well, both of those tax free, but what makes HSAs maybe even a little more valuable than Roth? And the fact that HSAs, you get an actual deduction for your contributions. You know, when I talked about Roth IRAs, I always have one or two trolls that put a few comments on YouTube and say, quit talking about Roth grow tax-free because you don't take a tax deduction on the contribution. It is true. Your basis into Roth IRAs is not tax-free. It's after-tax money. Contributions to a health savings account, you do indeed get a tax deduction when you fund it. There's benefit number one. Number two, all those years that those assets are invested and grow, you don't pay taxes on that growth. It's growing tax deferred. That's two. Number three is if you use the money for qualified healthcare or medical expenses, it is completely withdrawn tax-free. So that's right. You got a tax deduction when you put it in, you let it grow tax-free, and then you get to pull it out completely tax-free if it's for medical purposes. And there's a 4 and a 5 benefit too. And Bo just alluded to it. If you're doing this through your employer plan and you're funding this through your paychecks and so forth, you might be exempt from paying FICA or Social Security and Medicare taxes on that. That's another benefit. And here's number 5. I guess you call it Cinco on benefits of these HSAs, is that you're actually allowed to, once you get over age 60, 65, you can actually treat these as traditional retirement products, meaning that you don't necessarily have to use it for medical expenses. Use it for medical and healthcare if you want to be tax-free. But if you use it for retirement or just subsidizing lifestyle, you can get access to these funds. They're just taxed at ordinary income tax rates on the gains.
Now, here's one thing I love about HSAs, Brian. With Roth IRAs, they're so good that the government imposed an income limit. Said if you make over X amount of dollars, you cannot contribute to Roth IRAs. HSAs are not that way. There's no income limit on the ability to contribute or the ability to deduct contributions. The one thing that you must have, though, in order to be able to fund a health savings account is you have to be a participant in a high deductible health plan. You have to be covered either through your employer or through the insurance that you've bought for yourself or your family in a high deductible plan. If you are in a high deductible health plan, you can contribute to an HSA and you can take advantage of at least 3 of those 5 tax deductions.
So let's talk about the structure just slightly. In the high deductible health plan, the name would imply that more of the burden of healthcare is probably going to fall on the participant. It's not going to be, because I think a lot of people are used to PPOs and then the Cadillac type insurance policies. You walk into the doctor, you pay a $10 copay. The rest is taken care of by the health insurance. With a high deductible health plan, I'm just going to go ahead and tell you, your insurance policy is really catastrophic coverage only. The rest, you're kind of just getting access to their discounts of the provider. And that's why there are limits on how much you can put in these. If I talked about previously, step 1 was you get a tax deduction on what you put into health savings accounts. For in a single individual, it's $3,650 in 2022. For family coverage, it's $7,300. Those are the parts to take about. But here's what I think is interesting. If deductibles are so high, what should you keep cash? Should you invest? And that does lead to the setup, because I think most people, you would think after they cover their out of pocket in 1 year or their deductible in 1 year, they'd want to maximize the investment part. But Bo, that's not what the data shows. The data shows that 96% of people are just using this as a clearing account, meaning that they put the money in, they take a tax deduction in the current year of contribution, but then they have medical expenses and they pull the money right back out to reimburse themselves. You notice we just basically said, okay, that's step one. You put it in for a tax deduction. And then you took advantage of step three as you pulled it right back out tax-free to reimburse yourself. We skipped that also important part of the tax-free growth, that's right. Meaning that in order to take advantage of the true three triple tax advantage things, you have to actually invest a portion of this money so that it grows tax-free and that tax deferred. And then when you pull it out some point in the future, it's completely tax-free. There's only 4% of the population that's taking advantage of that financial mutant strategy.
Now, look, from a cash flow standpoint, it's kind of hard, because what are you actually doing? You're saying, I'm going to put money into a health savings account, and then I'm going to cover all of my other expenses from cash flow. I'm going to pay for that out of pocket. So yeah, it is a little bit more expensive from a cash flow perspective, but I do love, Brian, that what you can do is you can save all of those expenses you incur. So even if you're paying for it out of pocket right now, save the receipts, keep a spreadsheet, keep a running total. You can actually reimburse yourself from your health savings account at some point in the future for medical expenses that you incurred today. So if you get $10,000 into an HSA and it grows to $20,000, and over the last couple of years you've accumulated $20,000 of medical expenses you've paid for, you can reimburse yourself for 100% of those expenses tax-free. There is no statute of limitations on how long you can carry that forward.
I think my wife, because she knows I take receipts, she knows anytime we have eyeglasses for the kids, or she gets contacts renewed for herself, or just anything,
urgent care, any of that stuff.
You give me the receipt, I take it to work, and she finally asked me. This was only a few weeks ago. She goes, "What are you doing with all these receipts? I mean, what's going on? I don't understand the whole how this is working." I was like, "Look, here's the thing. I'm tracking all of these receipts. Yes, we're paying for it out of our own cash flow, but realize we have mega medical expenses, because having a special needs child with a special schooling, a special instruction site where I get a letter from the school and doctors and other things saying, hey, this school is because your kid is unique, and we are essentially a medical provider with all the therapies, occupational therapy, speech therapy, and all these other things. But you're not really getting to take advantage of, you're spending all this money. But here's what I daydream about. We all know the first 10 years of investing, that's not the meaty or frothy part of it. That's primarily your contributions into the plan. It's really years 15, 20, and even beyond where you get that exponential compounding growth. Right. I daydream about the fact, because I am tracking all these receipts, that my investment accounts and my health savings account are going to exponentially grow to where all that reimbursement, when I pull it out in retirement or whenever else, will be completely tax-free. I mean, that's the type of stuff that financial mutants are trying to figure out. How do we maximize and take advantage of the current tax policy to see, is there any opportunity for me to do this better?